Yes, people, I hope you all are doing super amazing, guys. People, after so long we are meeting today. After so long. Hello, everybody. Hello, everybody. Hi, guys. Hi, guys. People, come fast, come fast. Vasvi Lakshmi, Vaishnavi Nagaranjan. Good evening, guys. Good evening. How are you? Vasvi Lakshmi, Vaishnavi. How are you guys doing, guys? It is so good to see you all. Vaishnavi Nagaranjan, I'm doing perfect. How are you, Vaishnavi Nagaranjan? Vasvi Lakshmi, I'm doing fantastic. How are you, Vasvi Lakshmi? Guys, how is your preparation going on? We are very close to our exams, guys. How is the feeling, people? How is the feeling? Hi, Veni. How are you? Padmavati Srinivasan. Hi, Padmavati Srinivasan. How are you? Guys, I'm going to ask you a very bad question, that is, how is your preparation going on? Okay, people, to all the online students who have given me lots of love and support to my marathon series, thank you so much, people. Thank you so much. This really means a lot. I'm receiving YouTube comments like every single day. I'm receiving a super appreciating YouTube comment, people. Thank you so much for your love and support. Fine, sir. How are you? Padmavati Srinivasan, I'm doing fantastic. Okay. So guys, shall we get started, people? It's going to be a 2.5 hour session, people. So let's give it our best shot. And yes. So people, shall we get started? Give me a quick thumbs up, guys. I'm super excited to tell you the story about Dhirubhai Ambani, sir. Yes, people. All right, guys, let's get started with the insurance laws. People, whenever I teach any chapter from CMA final law or any chapter I teach, before beginning any chapter, I always tell them a super amazing, interesting story about that chapter. For example, if I'm teaching you FEMA laws, I will tell you a story about why Tesla cars are not in India. How is it directly connected to FEMA laws? Okay, in the same way, whenever I teach insurance laws to my students, I always tell them this amazing story, people. about Dhirubhai Ambani, how genius he was to make use of loophole in the insurance sector, and he managed to raise hundreds and crores of capital very easily at nearly half the cost of capital, while other businesses were raising capital at high interest rate. It's a super amazing story, people. Okay, so let's get started with the story, people. Okay, so the title of the story is, people, the man who outsmarted the insurance industry, how Dhirubhai Ambani changed the game. So people, while other businesses were borrowing loans traditionally, while other companies were raising capital traditionally, Dhirubhai Ambani was using the financial sector like a chessboard. He was using the financial sector like a chessboard, where every single time he was always 10 steps ahead of everybody else, whether it is insurance industry or whether it is his competitors or fellow businessmen. Let's understand now. Okay. People, before we begin, just give me a quick thumbs up if you have received all my notes. Insurance, laws, notes. If you have received, give me a thumbs up. Till then, I'm continuing with my story. So people, this is the period I'm talking about, 1990s. This story I'm talking about 1990s. There are two types of businessmen, people. Number one is normal businessmen, and on the other side was this genius businessman, Dhirubhai Ambani. Okay, so people, while other businessmen were borrowing loans, they were raising capital. Let's take interest rate as 15% interest rate. They were keeping collateral. Let's say they want to take a loan of 100 crores loan they want to take. For that, they used to keep collateral as 150 CR. That will include land, building, machinery, plant, everything, right? So people, for 100 crores loan, 150 crores worth security was kept as collateral. Interest rate was 15%. This was how normally businessmen would raise capital. And on the other side, Dhirubhai Ambani managed to raise loans at nearly half the interest rate without any collateral. Without any collateral. Now the important question is, how did he manage to raise 100 crores of capital without any collateral at half the interest rate? How is that possible, guys? Any guesses? Please, people, tell me. If you have got any guesses about what could be the possible way that Dhirubhai Ambani managed to raise hundreds of crores of capital at half the interest rate without any collateral. Okay, give me a response, people. I just want to know what could be the possible response that is coming into your mind. Okay, until then, I'm continuing with my story. Now comes the genius strategy. People, Dhirubhai Ambani, the first step that Dhirubhai Ambani did was he asked all his employees to take life insurance policy. Number one step was he asked all his employees to take life insurance policy. Life insurance policy. Now people, usually employees would take life insurance policy worth 1 lakh, 2 lakh, 3 lakh. But Dhirubhai Ambani asked all his employees to take life insurance policy worth 10 lakhs, 15 lakhs, 20 lakhs. So high value life insurance policy. Correct? Now the important question is, who is going to pay the premiums for the life insurance policy? Do employees have that much money to pay for the premiums? No. Dhirubhai Ambani said, I will pay the premium. Premium will be paid by Reliance. Premium would be paid by Reliance Industries. They just ask their employees to take life insurance policy, high value life insurance policy, and premium will be paid by Reliance. Okay, till then not a problem. Then came the third step, people. This was the master stroke. This was the master stroke. He asked all his employees to keep the beneficiary name as not their family members but Reliance. Beneficiaries name was Reliance and not family. Which means what, people? Tomorrow, if anything happens to their employees, who will receive the money, people? Reliance will receive this money. I came across one video of you starting that the company made itself. Yes, Vasavi Lakshmi, perfect, perfect, perfect. Amazing, guys. So Reliance asked all his employees to keep Reliance name as the beneficiary. Reliance name as a beneficiary. So tomorrow, if something happens to employees, Reliance will receive the money. Obvious. These were the three main steps. Now comes another important thing. Now Reliance went to the bank. Reliance went to the bank. They told the bank that we need 100 crores of loan. They told the bank we need 100 crores of loan. Bank told, then you have to keep collateral worth 150 CR. You have to keep collateral as 150 CR. Reliance told them that we will not keep any collateral. We will not keep any collateral. Bank employee said, how is it possible? How can you take 100 crores of loan without any collateral? Then Reliance told that keep these life insurance policy of my employees, where the employees have named me, have named Reliance as a beneficiary, have named Reliance as a beneficiary. The reason why bank accepted this is because, people, insurance policy is considered as a safe financial asset. Insurance policies is considered as a safe financial asset. People, you tell me logically, will insurance policy, will it ever lose its value? No, you will not lose its value. The moment you surrender the insurance policy, you will obviously receive the money. The moment you surrender your insurance policy, you will obviously receive your money. But this is not the same in case of land, building, plant, machinery, which will obviously, people, in the future it might depreciate in its value. It might depreciate in its value, and any asset kept as collateral which will depreciate in its value will always carry risk. And wherever there is risk, people, wherever there is risk, there is always high interest rate. Wherever there is high risk, there is always high interest rate. But wherever there is low risk, there is low interest rate. So Reliance Industries kept all these life insurance policy as a collateral, because of which it was a safe financial asset. Risk was low, interest rate was low, and bank, they gave them 100 crores of capital without any actual collateral like other companies, machinery, plant, building, land. So Reliance managed to get 100 crores of loan at nearly half the interest rate, number one. And number two, they did not keep any collateral. No collateral of them was blocked with the bank. And this was how Dhirubhai Ambani made use of loophole in the insurance sector. Now the important question is, what exactly was the loophole? What exactly was the loophole is the important question. The loophole was, people, the loophole was in the Early Insurance Act. In the Early Insurance Act, nothing was clearly mentioned about who can be the beneficiary. Nothing was clearly mentioned about who can be the beneficiary. And Reliance used this loophole and kept their name as a beneficiary. Kept Reliance name as beneficiary. Now, after that, people, everybody were confused. How is Reliance managing to raise such huge amount of capital at clearly low cost of capital? How is it possible? until they were able to figure it out, Reliance was already way ahead of everybody else. They used their money such amazing manner that when they realized, oh my God, this is a loophole, and then when they tried to fix that loophole, until then people, Reliance was way ahead of their time because of capital, because of such huge capital at low cost. After that, beneficiaries were clearly mentioned, who can be beneficiary, who cannot be beneficiary. This was how Dhirubhai Ambani managed to raise hundreds of crores of capital at nearly lowest cost of capital, people, lowest cost of capital. So people, how did you like this story, people? People, now is insurance law interesting? Now tell me, people, do you find insurance laws interesting now? A lot of people told me on day 1 or day 2 of the marathon session that insurance laws is boring. Now people tell me, after listening to the story, are you finding insurance laws super interesting, people? Perfect, perfect, perfect. All right. So people, with this, let's begin our chapter of insurance laws. Let's begin with the chapter of insurance laws. People, in this chapter, we are going to cover top 10 questions, top 10 topics we are going to cover. Once you are done with this top 10 question, people, that's it. You are sorted for insurance laws. You are sorted for insurance laws. If you look at my notes, people, my notes follow the same structure like my marathon notes. Easy language. I've included lots of examples. Vijay Lakshmi, yes. Hi Vijay Lakshmi, where are you from? With real examples, you always make things simple to understand. Thank you, Vasi Lakshmi. Thank you so much. Vijay Lakshmi, where are you from? Just let me know, okay? Until then, people, let's get started. The first topic is basic principles on which insurance laws are based. Basic principles on which insurance laws are based. So, people, there are basically six principles. Number one is, people, principle of good faith. Let's understand this using an example, then we will come to the explanation part. What does principle of good faith means? A person hides a heart condition. A person hides a heart condition when buying health insurance. The insurer can reject the claim later if discovered. People, you are going to buy a life insurance policy. Now, you did not disclose to the insurer that you have a heart condition. You did not disclose it to the insurer. Now, people, later on, if it was discovered that you had a heart condition by the insurance company, your policy can be cancelled or your claim can be rejected. Now, let's come to the explanation part. Insurance contracts are based on the principle of uberi me fide, which means utmost good faith. Both parties, insurance company as well as the insured, must disclose all material facts. Very, very honestly, they have to disclose. If I have a habit of smoking, I should disclose to the insurance company that I have a habit of smoking. If I have a heart disease, I have to disclose to the insurance company that I have a heart disease. Right, people? So, the principle is principle of good faith. Chennai sir, first class, Vijay Lakshmi. எப்படி இருக்கே? சென்னை எப்படி இருக்கு? Pooja Gupta, hello, good evening, sir. Hi, Pooja Gupta, good evening, good evening, good evening. Pooja Gupta, you missed one amazing story. Just after this marathon, after this video ends, just go back and then watch my story, okay? It is super interesting story, guys. All right. The second principle is, people, principle of misrepresentation. Let's understand this using an example. A person falsely claimed that they don't smoke. People, same example, while buying life insurance. Later, the insurer may cancel the policy. Why? insurer have clearly asked you, do you smoke or not? You gave him false fact that you do not smoke. Not good, people. So misrepresentation happen when one party makes false or misleading statements before or during the insurance contract. If you are making false statement or misleading statement before or during the contract, it is called as misrepresentation. Okay. People, can you tell me the difference between principle of good faith and principle of misrepresentation? Can you guys tell me the basic difference between principle of good faith and principle of misrepresentation? People, basically in principle of good faith, you are not disclosing material fact. But in principle of misrepresentation, you are falsely disclosing material facts. Number 3, misrepresentation always makes contract invalid. Okay, the contract becomes voidable at the option of insurance company. Insurance company can cancel the contract. They can cancel your claim if it was made deliberately to cheat the insurance company. Next, warranty. What do you mean warranty, people? A warranty is a promise by the insured to fulfill certain conditions. Breaching a warranty can void the policy. Okay. People, a factory owner wants to keep his goods insured against fire. A factory owner wants to keep his goods insured against the fire. Now, insurance company have clearly told the factory owner that you have to keep fire extinguisher in your factory. You have to keep fire extinguisher in your factory. That factory owner did not obey to whatever insurance company told them. So now, if they have not kept fire extinguisher in their factories and then fire came and fire have burnt all the goods, in that case, people, insurance company will not be liable to pay them any money because there was a condition that you have to keep fire extinguisher in your factory. If a factory owner violates the warranty to maintain fire extinguisher in a fire insurance policy, the insurer can refuse to pay. Easy, people. Next, 5th condition. Conditions in insurance contract. Conditions define the limitations and obligations. What can be conditions? There are 3 types of condition, people. There are 3 types of condition. Number 1 is conditions before the contract, condition during the contract, and implied conditions. Next is implied conditions. Condition precedent means, for people, condition that must be fulfilled before the contract becomes valid. Example, a trucking company must conduct regular safety check. Okay, a person must undergo medical examination before getting health insurance. So before you take life insurance policy, you have to get yourself medically examined. You have to get yourself medically examined, and that is called as conditions precedent. Before you take life insurance policy, you have to follow certain condition like medical examination during life insurance policy. Number 2 is, people, conditions subsequent to insurance contract. A trucking company must get itself safety checked every regular intervals as prescribed by the insurance company. Now, if the trucking company is not getting itself safety checked, and then they met with an accident, if something happens to a truck, then the insurance company will not be liable to pay them. Why? Because there was a condition that you have to get yourself safety checked regularly. Trucking company did not do, insurance company is not liable to pay the money. Number 3 is, people, implied condition. Implied condition means what, people? Even if not stated in the policy, the insured must act in good faith and have insurable interest. We're going to understand what is the meaning of insurable interest. Automatically included by law even if not mentioned. People, principle of good faith, nobody will tell you that you have to act in good faith. It is implied. Nobody will tell you. It is implied by law. And apart from that, there are certain conditions called as undisclosed condition. What is the meaning of this? Insurers can't include hidden conditions to unfairly reduce their liability. Tomorrow, if something happens to my factory and my goods are burned, and then I go to the insurance company to claim my policy, to claim my insurance amount. They cannot tell me that no, one more condition is there, but we did not include in the contract. No, that is not allowed. Whatever conditions are there, every single thing should be mentioned in the insurance contract. That's it. So we studied principle of good faith, principle of misrepresentation, warranty, then misrepresentation makes the contract invalid, then conditions, and last is undisclosed conditions. So we are done with the basic principles on which insurance laws are based. Pooja Gupta, little nervous, sir. For example, Pooja Gupta, if you are little nervous, you are absolutely normal. If you are not nervous, then that's a problem. Vijay Lakshmi, good sir, I'm doing articles, so I couldn't attend your live session, but I watched all your marathons gratefully today. I got a chance to attend live. Oh my God, Vijay Lakshmi, you made my day. Thank you so much, Vijay Lakshmi. Thank you so much. It means a lot. It really means a lot, guys. Okay, guys. So we are done with the first topic, that is basic principles on which insurance laws are based. Now let's come to the second topic, that is difference between indemnity and subrogation. Difference between indemnity and subrogation. People, do not get panicked when you look at such long text. Do not get panicked. All are super easy, people. Super easy. Okay, don't get panic at all. Okay, all right. Yes, difference between indemnity and subrogation. Difference between indemnity and subrogation. People, just one sec. Yes. Basic difference. If you want to explain this to a 16-year-old kid, how will you explain the difference between indemnity and subrogation? Indemnity means what, people? You only get what you lost. Subrogation means insurer takes your legal rights after paying you. Let's say I am driving a car. I was hit by a person. Now that person will have to pay me money. Now insurance company, if they will pay me money, that is called as indemnity. Insurance company, if they pay me money, that is called as indemnity. Now if I want to recover money, from this person, now insurance company will pay me money. Now they will absolve me from the liability. Now insurance company will come into my shoes and file a legal complaint against this person. Let's understand this using an example. Guys. Okay, example. Guys, just tell me if you are able to look at my screen, if my screen is visible or not, guys. Vijay Lakshmi, Pooja Gupta, Vasri Lakshmi, Veni, Vaishnavi Nagaranjan, Jack. Jack is saying MCQ. Jack, day after tomorrow, MCQ. Today, insurance laws, tomorrow, banking laws. Jack, okay. Padmavati Srinivasan, just quickly tell me, guys, if you are able to see my screen very clearly. Perfect. So people, let's understand this using an example. We will always go out of the syllabus to understand the syllabus. Okay. Indemnity. What does indemnity means, people? A car worth 5 lakhs is damaged. The insurer pays 5 lakhs. Okay. Let's not complicate it, people. Insurance company will pay 5 lakh rupees. My car got damaged. Insurance company paid me 5 lakh rupees. This is called as basic indemnity. Now, what is the meaning of subrogation? If a third party caused the accident, the insurer can sue them to recover the amount. The one who was hurt, instead of that person filing a case against the person who was acting negligently, insurance company will come into my shoes and file a case against that person. This is called as subrogation. Insurance company will come into my shoes and then they will exercise the legal rights. This is the basic difference between indemnity and subrogation. Let's understand, people. It's a legal principle where the insurer compensates the insured only for the actual loss suffered, restoring them to the same financial position before the loss. Very easy. What is meaning of subrogation? It is a legal right. It is a legal right, people, that allows the insurer to step into the shoes of the insured after settling a claim to recover the amount from a third party responsible for the loss. This is a basic difference between subrogation and indemnity. Now, applicability applies to all general insurance, marine, fire, motor. It is not applicable to life and personal accident policies. Okay. Subrogation applies only after indemnity is provided to the insured. Which means what, people? Please share notes on insurance. Padmavati, you will find a link in the description. Just follow that link, Padmavati, and you will get your notes. Okay? Don't worry. Yes, people. Applies only after indemnity is provided to the insured. Which means what, people? Basically, the moment I receive compensation, when I receive compensation from the insurer, then the insurer will come into my place and then he will file a case against the third party. Very easy, people. It is not applicable in life or personal accident insurance. Very easy. Next, objective: to ensure the insured is not unjustly enriched. Which means what, people? You are also filing a case against the person and you are also collecting money from the insurance company. Not allowed. They are only made whole. Ensures the insured cannot recover twice. Same, people. Next, rights of the insured. The insured can claim only actual loss. Obviously, if they have recovered from a third party earlier, the insurer reduces the payout. 5 lakh damage was done. 1 lakh was paid by the third party. I cannot recover again 5 lakhs from the insurer. I can only recover 4 lakhs from the insurer. But in subrogation, after receiving payment, the insured loses the right to claim separately from the wrongdoer. The right now belongs to the insurer. Which means what, people? The moment insurance company have paid me money, now I don't have any legal right to file a case against third person. Now insurance company will file a case against that person. That's it, people. That is called as principle of subrogation. Practical implication: ensures fair compensation, reduces moral hazard, prevents double recovery, reduces insurer losses. Very easy, people. Exceptions: not applicable to life insurance, people. The reason is life insurance policy always does not have any value. We do not have any value. Quantifiable value we do not have. Valued policy may pay agreed value instead of actual loss. It is not applicable if insurer waives right. What is the meaning of this, people? It is not applicable if insurer waives right. Which means what? If insurance company have told clearly in the contract that, one sec, people, one sec, we will pay you if there's damage, but we won't step into your shoes to file a case against that person. If insurance company does not want to file any case against the third person, they don't want to waste their time. They are just concerned with that. You have suffered a loss, we will pay you money. That's it. In that case, people, subrogation principle will not apply. Very easy. Cannot sue family or close relations unless deliberate harm is proven. Insurance company will not file a case against the mother, father, brother of the third party unless they were also involved in the harm. That's it, people. Very easy. We are done with distinction between indemnity and subrogation. We are done with indemnity and subrogation. All right, people. Now next is yes. People, one more thing is there. Let's quickly read it. We are done with indemnity. We are done with, okay. This is pure indemnity. This second topic talks about pure indemnity. What is the meaning of this? Indemnity refers to compensation for actual loss. Most insurance policies are indemnity contracts, the insurer pays for the actual loss suffered. Actual loss suffered. People, let's take an example of BMW. I have bought a BMW worth 2 crores. Now, I have met with an accident. Now, if my policy value is 1 crore, maximum amount I can recover from insurance company is 1 crore. I cannot recover more than 1 crore rupees. Saying that, no, for me, BMW is worth more than 1 crore rupees. I cannot say that. Only for actual loss, only for actual damage, you will receive money, not more than that. Yes, people, this is called as indemnity. Key rule, based on actual loss, not exceeding actual amount, not exceeding the actual amount of damage. Okay. What are the conditions for indemnity? There are 3 conditions, people. 4 conditions. Number 1 is, insurer must prove that they suffered a loss. If your car is not damaged, why would insurance company pay you money? Rahul must provide proof like photos, reports, etc. of the fire damage to his warehouse to claim insurance. Next is indemnity limited to policy amount. Obviously, you cannot recover money from the insurance company more than your policy amount. If Priya's house is insured for 1 CR, but the damage is 1.2 CR, the insurer will only pay you maximum how much? 1 CR, people. Very easy. Proximate cause. The loss must be directly caused by insured event. If I had taken fire insurance policy and my goods were stolen, in that case, I cannot go to insurance company telling them that I need now insurance money. Why? Because insurance was only against fire insurance. Insurance was only for fire insurance. It was not for goods stolen. Right, people? Very easy. And next is market value determines compensation. If my market value of my damage is, let's say, Sunita's car, originally worth 10 lakh rupees, is damaged in an accident. If the market value at the time of compensation, at the time of accident is 6 lakh rupees, the insurer will pay 6 lakhs as a compensation. Very easy, people. Market value. That's it. This is the meaning of indemnity. Now, let's understand. People, this is same again. Very similar. Now, let's come to the insurance and consumer protection. Everybody with me, give me a quick thumbs up, guys. Are you able to now visualize whatever I'm trying to tell you using examples? Everybody with me, give me a quick thumbs up, guys. Give me a quick thumbs up. People, there are always 2 barriers that stops you from learning. There are always 2 walls that stops you from learning new things. Number 1 wall is the language is difficult. The language is difficult. Or number 2 wall is the content is itself boring. So people, the wall number 1, I have removed it completely by making the language easy to understand. And wall number 2, if it is boring, I've included real life examples to make it interesting. Yes, people? Perfect. Yes. Riya, Katuria, how are you, Riya? I've seen you last in my marathon lectures. Pooja Gupta giving me thumbs up. Veni, yes sir. Vaishnavi Nagaranjan, Vijay Lakshmi. Perfect, guys. Perfect. Thank you so much for staying with me, guys. Okay. Now, let's understand what is the relationship between insurance and consumer protection. People, let's understand this using an example. Ravi's health insurance claim is rejected without a valid reason. Ravi's insurance claim is rejected without a valid reason. Ravi can file a complaint against Consumer Forum. Ravi can file a complaint against insurance company in the Consumer Forum. Very easy. Consumer Protection Act protects consumers from unfair trade practices and deficiency in services. Insurance services fall under the Act. So people, if insurance company is not paying you insurance money, number 1, if they are delaying paying you money, or if they are paying you reduced money, in that case you have every single right to file a case against the insurance company in the Consumer Forum. Very easy. Next is common insurance disputes under CPA. Common dispute is claim rejection. Your claim has been rejected. Claim amount issues. Unreasonable delays. Just now I told you, people. insurance companies are not consumers. Insurance company cannot file cases in consumer forum. They must go to civil courts for disputes. Tomorrow, if I have taken life insurance policy by fraud, by not disclosing them anything, and then I have also received money. Now, if it was later discovered that I got the insurance money by fraud, insurance company cannot go to consumer forum. They have to go to civil court to recover money from me. Right, people? Next is, who is a consumer? A person who takes insurance for personal use or to hedge a risk is a consumer under Consumer Protection Act. I cannot, if I have a commercial risk, I have to go to civil court. If I am a consumer, I have taken insurance for my personal risk or for hedging my risk. In that case, I have every single right to go to consumer forum. Other than personal use, then I cannot go to consumer forum. Ajay buys health insurance for his family. If anything dispute, if insurance company does not pay him money, if they pay him less money, if the claim is rejected, in that case he has every single right to go to consumer forum. Valid consumer. Shreya owns a small business. People, small business is very, very important. If you are self-employed, and something happens to your business, if something happens to your business on which you are completely dependent, in that case, if something happens to your business, you can go to consumer forum. If insurance company is not paying you any money, but who is not a consumer? Rahul, an insurance agent, takes insurance for business. He is not a consumer. He is not a consumer. He has to go to civil court now. He has to go to civil court. Always remember, people, this is very, very important. Personal use, and yes, personal use is very, very important. Okay, if you have taken an insurance policy against business, then you have to go to which people? You have to go to civil court and not consumer court. Right, people? If you are owning very, very big business, again, you have to go to civil court and not consumer court. If you are owning a small business on which your complete income is dependent on, in that case, you can go to consumer forum. Very easy, people. Yes. Now, let's come to the fifth topic, that is insurable interest. Insurable interest. Everyone with me? Riya Katuria, I am good, sir. How are you? Riya Katuria, I am doing fantastic. Doing fantastic, Riya Katuria. Yes, people. Cool. People, tell me one thing. Don't you guys want to study for the exams? I never expected that you will show up. Vijay Lakshmi, Vaishni Nagaranjan, Veni, Pooja Gupta, Padmavati, Riya Katuria. Everyone, just a quick question out of curiosity I am asking. You have got exam next, very soon you have got exams. Now, don't you want to study for exams? Actually, I expected that nobody is going to be shook. Nobody is going to show up in my live lecture. But very, very surprisingly, so many people have come live. That's really surprising, people. How is it possible, guys? How is it possible? Yes, people, answer me. Until then, I will continue my topic, okay? Just answer me. Insurable interest. What is the meaning of insurable interest? Okay, let's understand this using an example. Ramesh insures his own house. Allowed. He has got his insurable interest. Ramesh house. He is completely financially and emotionally dependent on the house. Pooja insures her neighbor's car. Pooja insures her neighbor's car. If something happens to neighbor's car, will Pooja be affected emotionally or financially? No. So in that case, Pooja does not have an insurable interest. Now let's understand this explanation. A legal requirement that the policy holder must have a financial or emotional connection to the subject matter of insurance. Without it, the contract is void and it is a wager. It's a wager. You are getting into a contract without any emotional or financial connection. That is called as wager. Amit takes life insurance for himself or spouse. Valid. Amit has got an insurable interest. Invalid. Rohit insures a random stranger. Does that random, if something happens to a random stranger, will Rohit get affected emotionally or financially? No. That means Rohit does not have a insurable interest. Very easy, people. Who can possibly have insurable interest? Depends on the relationship to the insured person or property. It can be a creditor debtor, it can be an employee employer. If an employer is not paying, if employer is supposed to pay to the employee 1 lakh rupees salary for 3 months, then employee can take a life insurance policy on behalf of the employer. Why? Because if something happens to the employer, people, who will give this salary to the employee? That means financial connection is there, emotional connection is not there. Who has emotional connection towards the employer? Right, people? So Rahul does not have a emotional connection towards the employer, but he has got a financial connection. For that purpose, he has taken a life insurance policy on behalf of the employer. If something happens to him, Rahul will get the money. Next is creditor debtor. Same people. Creditor debtor. Creditor can take a life insurance policy on behalf of the debtor. If something happens to your debtor, life insurance company will pay to the creditor the money owed by the debtor. Very easy, people. When should insurable interest exist? If it's a life or a personal accident, at the policy inception only. It should always in the beginning. It should always exist in the beginning of the insurance. When wife buys insurance for husband, later they get divorced, it will be still valid. It would be still valid. So life insurance policy, if it is valid, if insurable interest is there in the beginning, it is completely valid. Even if insurable interest is not there after entering into contract, it is irrelevant. If it was there in the beginning, if insurable interest means financial or emotional connection was there in the beginning for taking life insurance policy, it is completely valid. Fire and motor, at inception and at the time of loss. In the beginning and at the time of loss, insurable interest should be there. Ramesh sells factory but does not cancel insurance later. Fire, no compensation. So people, Ramesh owns a property. Didn't study this chapter. Western no problem. Perfect. You are watching this lecture at the right time. Okay, guys. Fire and motor insurance. Ramesh owns a factory. He has taken a fire insurance. After 3 years, he has sold the factory. Still, for 5 years, 6 years, he was paying premium. Now, after 6th year, 7th year, 8th year, something happens to the factory. Now, he cannot go to the insurance company to claim insurance amount. Marine, only at the time of loss. Trader buys policy before owning goods, owns them at the time of loss. He can claim. People. Yes, people, understood? Everybody with me? Give me a quick thumbs up, guys. Give me a quick thumbs up. For every single provision I'm teaching you, I've given you examples. For every single provision I'm teaching you, I'm giving you examples. So you don't have to worry at all. Okay? After this marathon video ends, tomorrow, just learn whatever I have included in the notes. Once you learn whatever I have included in notes, people, that's it. I'm telling you, people, insurance company is going to be the best chapter, people. Insurance company is going to be the best chapter of all the chapters that you have studied. Perfect. Now, 4th and 5th point. Limited insurable interest. A person may have limited rights in a property and can only insure to that extent. What is the meaning of this? Let's understand this using an example. A tenant can insure their leasehold interest, not the full building. Okay. People, let's say I am a tenant of this building, 3rd floor. Now, I cannot take insurance for this whole building. I can maximum take insurance for what purpose? Only for my home. For that home where I have incurred my expenditure on furniture, I have a sofa, fan, tube lights, bed, every single thing where I have incurred expenditure, for that is my insurable interest. Now, have I incurred any expenditure in building, in constructing the whole building? No. Only for the flat that I am living in, for only that purpose I have insurable interest. Now, a tenant can insure their leasehold interest, not the full building. Now, let's understand this again. A person may have limited rights in a property and can only insure to that extent. Now, is it making sense, people? Now, is it making sense? Next, when does insurance cover starts? By default, it starts from 12 a.m. midnight on the date of issue, unless specified otherwise in the policy. If in the policy it was mentioned that some other date, some other time, then we have to follow that time. Otherwise, we have to follow which time? 12 a.m. hours. Policy issued on 10th Feb at 3 p.m. Coverage starts from 12 a.m. 12 hours of 10th February. If stated in contract, starts from issuance, covers only 3 p.m. events. Covers only post 3 p.m. events when, if it is mentioned in the contract. If it is mentioned in the contract. Again, people, one more important thing is, if the insurance company has received premium from you, only from that date onwards, you can claim money from the insurance. If you have not paid premiums, on the day of issuance of policy, if something happens, let's say you have taken a fire insurance on the factory on 10th February. If something happens to your factory on 10th February, you will still not be able to recover money from the insurance. Why? If you have not paid premium, in that case, insurance company is not going to pay you anything. If you have paid premiums, if you have done everything from your part, then you can claim recovery money. Otherwise, you cannot claim recovery money. So, if policy is issued once again, people, if the policy is issued on 10th Feb at 3 p.m., coverage starts from 12 o'clock of 10th February. That's it. That's it. Now, people, now let's come to the 7th point. We are halfway done, people. We are halfway done. Vijay Lakshmi, Pooja Gupta, Vaishnu Nagaranjan. I hope it is super interesting, guys. Before your dinner, I will try to complete off with this insurance chapter, okay? All right. Here, once again. Yes. People, the section that we are about to learn right now, section 45, is a super interesting provision. It is a super interesting provision. Why? I will tell you. This provision says that if you have taken life insurance policy by fraud, still you will end up getting money from the life insurance company. If you obtain life insurance policy by fraud or by illegal means, still you will end up receiving the insurance amount. Why and how? This we will understand in this section. Let's understand this using an example. A person hides a heart disease. Person hides his heart disease. If detected within 3 years, insurer can reject the claim. If it was undetected, if it was detected within 3 years, insurance company can reject the claim. So insurance company have got 3 years to find out does he have any health issues or not. If he does not have any health issue, people, okay, that is not relevant. We will only talk about fraud. Okay, we will only talk about fraud. Insurance company have got 3 years to confirm that whether he has got any health issue or not. If he has got a health issue within 3 years, insurance company can cancel the policy. If after 3 years it was detected that this guy has got a heart disease which he did not disclose, in that case, people, insurance company have to pay to that person the claim, even if it was obtained through fraud. Even if it was obtained through fraud. Now, key takeaway is that after 3 years, the insurer loses the right to deny a claim, even if the insured person obtained the insurance by fraud. The reason is to ensure finality and protects honest policyholders. People, those who are honest policyholders, they will completely, again and again, they will get panic, they will get anxious that what if insurance company will reject a claim? What if something has happened to us? What if something rare illness has been detected? In that case, insurance company will not pay us money. To avoid such unnecessary panic, to remove this unnecessary planning, IRDA has given a law that insurance company have got 3 years time. Insurance company have got 3 years time to find out if that person is suffering from any disease or not. If that person is suffering from disease, immediately you can cancel the policy, provided you detect the person's health issue within 3 years. If after 3 years you detected that the person has got a heart disease, still you have to pay that person the money that he claims, even if it was obtained through fraud. Right, people? Now let's understand the meaning. After 3 years from the date of policy issuance, the life insurance policy cannot be questioned, even if it was obtained through fraud, misrepresentation or concealment. Concealment means hiding. Applies to all life insurance policy issued in India. All life insurance policy issued in India. During first 3 years, insurer can investigate and reject the policy if material facts were suppressed or misstated. Fraud is proved. Insurer must give a written notice to the insured if their policy is cancelled in writing that why exactly that we are rejecting your claim. But after 3 years, this is very important, insurer cannot cancel or deny the policy even if fraud is later discovered. Policy holder is fully protected. Claim must be honored. To protect policy holders from indefinite uncertainty about their claim status, promotes trust. Only for that purpose this law is made. Policy not to be called in question after 3 years. Policy cannot be questioned after 3 years, even if it was obtained through fraud. This is the most beautiful section that I have come across insurance lobby, where we are finding out that fraudsters are protected. Fraudsters are protected. Section 45. Yes, people. So we are halfway done, people. Halfway done. Now let's come to the surveyors and loss assessors. Very, very easy, people. Very, very easy. Let's quickly understand it. Let's understand this using an example. A fire breaks out in a textile mill. A fire breaks out in a textile mill. Insurer appoints a licensed surveyor to assess the actual loss. Now, who is going to? Now, will insurance company's director going to check if actual loss was caused? What was the cost of what was the actual damage caused? No, they will appoint surveyors. Like companies appoint auditors, the same way insurance company appoints surveyors to find out what exactly was the actual damage suffered by the insured person. Surveyors gives an unbiased report. In the same way we give audit report, surveyors also give unbiased report to help insurer decide the compensation. The surveyor cannot favor either party. In the same way, auditor cannot favor any party. In the same way, surveyor also cannot favor any other party. Now let's come to the explanation part. They are professionals like us appointed by insurance companies to assess the actual loss or damage and help determine fair claim payouts. Very easy. They should have prescribed qualification like we have got CMA, CS. In the same, they should also have got prescribed qualification notified by IRDAI. In the same way, we have got ICMAI, ICSI. In the same way, they have got IRDAI. They should also have mandatory membership. Firm and company. If a firm or a company is appointed as a surveyor, all directors, partners involved in the assessment must be qualified and licensed surveyors. People, we all have gone through trainings and internships. So obviously, people, we have worked in companies also, we have worked in firms also. So always, if I have worked in a practicing company secretary firm. In the same way, if a firm is appointed during assessment, it should be ensured that all the people who are engaged in that assessment all have got proper qualification and license surveyors. Very easy. Everybody should have a code of conduct. Like we have code of conduct, they also have a code of conduct. That's it, people. We are done with the surveyors and laws assessors section 64 UM. People, if I'm going too fast, just let me know. I will decrease my speed. If I'm going too fast, let me know. I will decrease my speed. Yes, people, everyone with me? Everybody with me or not, people? Everyone. Yes, people. Now, let's come to the ninth topic, that is sufficiency of assets, section 64(5). Solvency requirements for insurers and reinsurers. Can anyone tell me the meaning of reinsurers? Can anyone in this group tell me the meaning of reinsurer? People have got a lizard above on the ceiling. I'm just scared that it will fall on me. Yes, people. Yes, people. Yes, people. Tell me the meaning of reinsurer. Yes, people, anyone. If you don't know the answer, give me a quick thumbs up so that I don't wait. Okay. Otherwise, you will think, what is the reinsurance meaning? And I will think, assuming that you know the answer. Will continue till 1 hour like this only. If you know the answer, people, just let me know the answer. If you don't know the answer, give me a quick thumbs up. Okay. Give me a quick thumbs up if you don't know the answer. Okay, so I will tell you the meaning of reinsurer. Reinsurer. Let's say people in Pune, let's say people in Chennai have taken life insurance policy. Life insurance policy. Now, Chennai people, now recently a flood has come to Chennai. Flood has come to Chennai. Now people, now this insurance company, A insurance company, is now scared that will we be able to pay? Will we be able to pay money to all the insured people to save itself from expenses? A will take again policy from B. A will take a policy from B. Both are insurance company. Insurance company. Now, if flood or tsunami comes to Chennai, I hope I will pray to God it should not be true. Just giving you an example, people. Okay, just giving you an example. If something happens to Chennai, this insurance company will have to now bear a very big burden. It has to pay now very big burden. So for that purpose, this company will take a insurance company from B company, so that risk will be shared among two people. This is the meaning of reinsurance. So B is the reinsurer. Chennai people, so sorry to give you such examples. Okay, I'm so sorry. Okay, now let's understand the Section 64(5), sufficiency of assets. Sufficiency of assets. Again, people, always we will start with example. If an insurance company has liabilities 200 crores, minimum capital requirement is 100 crores, then they must have assets. How much? 50 CR excess of the liabilities. They should have assets. They should always have assets more than 50. If this excess drops below 50 CR, IRDA may step in. Now let's understand the explanation part. Explanation part. To ensure financial health of the insurers and to protect policy holders by requiring insurers to maintain a minimum solvency margin. Obviously, people, no company can start insurance company when they don't have any money. They should have some money. Now, what is the minimum asset requirement? Insurers and reinsurers must maintain assets exceeding liabilities by how much? 50% of minimum capital. Minimum capital. Let's say minimum capital is 100 crores. 50% of 100 crores is 50 CR. 50 CR. If liabilities is, let's say liabilities is 500 CR. Then can you guys tell me what should be the maximum, what should be the minimum asset requirement? What should be the minimum asset requirement? Vaishnavi, Vijay Lakshmi, Pooja Gupta, Riya, Veni, Padmavati Srinivasan, Jack. Where is Jack? Can you guys tell me what is the minimum asset requirement? Minimum asset requirement. Minimum capital is 100 CR. 50% is 50 CR. Liabilities is 500 CR. Asset requirement is how much, people? Asset requirement is Vijay Lakshmi. Liabilities is 500 CR. Assets should always exceed by liabilities by how much? By 50% of minimum capital. 50% of minimum capital is how much, people? Minimum capital is 100 crores. 50% of 100 crores is 50 CR. If liabilities is 500 CR, assets should be 500 CR plus 50 CR. This is the basic rule. This is the basic rule. Guys, just take a quick thumbs up. Just take a quick screenshot. Take a quick screenshot. Basic rule says that assets should exceed liabilities. Assets should exceed liabilities. This is the basic rule. By how much? By 50% of paid up capital. By 50% of paid up capital. Right, people? This is the basic meaning. Now, let's understand this. Consequences of non-compliance. If solvency margin is not maintained, insurer is deemed insolvent. IRDA can approach the court for winding up of the company. IRDA can approach the court for winding up of the insurance company if they are not maintaining the minimum capital margin. They are not having minimum asset cover. Okay. So people, this you have to just read it, okay? Just read this. IRDA prescribes control levels for solvency. Obviously, if an insurer falls below this margin, IRDA can impose restrictions on new businesses. Demand financial restructuring. They will ask the company to restructure itself financially, even cancel their registration. Cancel their registration. Vijay Lakshmi, how can it come to 750 crores? No, Vijay Lakshmi, it will not be 750 crores. Rule says asset should be more than liabilities, number one. But by how much? By 50% of not asset, not liabilities, 50% of minimum capital requirement. If minimum capital requirement is 100 crores, 50% of 100 crores is 50 CR. That means asset should exceed by liabilities by 50 CR. Easy people, very easy. Okay. Now, next is super easy concept. Types of insurance policy: life insurance, fire insurance, marine insurance, health insurance. Let's quickly understand this. Provides financial protection in case of death or in case of maturity. Which means for people, let's say I have taken life insurance policy, normal, ideal life insurance policy. If something happens to me, my family will receive money. This is ideal life insurance policy. There is one more thing called as endowment policy, which says that the policy will be for a period of 15 years. If within 15 years, if something happens to me, my family will receive the money. If after 15 years, if nothing happens to me, I will receive the basically money. I will receive the insurance amount. Along with bonuses, because I survived 15 years. For that reason, I will receive amount. So, life insurance policy is not a case where only in case of death you will receive money. No. Even if you don't die, you will receive money. But they are different life insurance policy. We'll understand this. Okay. Term plans is what? The same term plans is ideal life insurance policy where you receive money when you die is called as term plan. Endowment plan means what people? Just now I told you endowment plans. If I survive for 15 years, I will receive money along with bonuses. There's one more thing called as ULIPs, Unit Linked Insurance Plan. Unit Linked Life Insurance Policy. What is the meaning of this, people? Basically, if I pay 10,000 rupees as premium, if I am paying 10,000 rupees as premium, 5,000 rupees will go to insurance and 5,000 rupees will go towards investment. Right, people? So, if I am paying 10,000 rupees premium, 5,000 will go towards insurance and remaining 5,000 will go towards investment. Next, fire insurance, people, covers loss or damage due to fire. Very easy. Lighting, explosion, etc. A factory insures its warehouse against fire damage. Ideal example for business and property. Marine insurance, goods lost in sea due to storm are compensated under marine insurance. Very easy. Protects goods, cargo, ships during transport by sea, air, land. Covers risk like storms. Next is health insurance. A person gets cashless treatment at a hospital using their Mediclaim policy. We all know this, people, Mediclaim policy. You can get yourself treated without cash. This is called as because you have a health insurance. Covers medical expenses like hospitalization, surgeries and treatment. Offers cashless or reimbursement options. So people, we are done with types of insurance policy also. Okay. So people, in this note, there are certain topics which I believe that you can study it on your own. Okay. So I would request you all to read certain topics at home because they are super easy. So otherwise what will happen is viewers will think that this video is 3 hours long, so they will not watch insurance chapter at all. My goal is to complete this chapter by 9 o'clock max, by 9 p.m. max. Okay. So whatever topics I will tell you to learn at home, you have to learn it. Okay. Give me a quick thumbs up, guys. Give me a quick thumbs up. Let's take a break of 5 minutes. Are you guys okay with a break of 5 minutes? Give me a quick thumbs up. We are almost done with our insurance chapter, people. We are almost done with our insurance chapter. Let's take a break of 5 minutes, guys. All right, perfect. So let's meet at 8:20, 8:21, 8:21 break, 8:21 break. Yes, people, I will see you in at 8:21. Hello, people. Yes, people. Yes, people. Yes, people. Welcome back, guys. Welcome back. Welcome back. Welcome back. Everyone with me, give me a quick thumbs up, guys. Yes, people. Hello. 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 Everybody, give me a quick thumbs up, guys. People, hello, 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 everyone, hello, everyone. Guys, give me a quick thumbs up, guys. All right. Veni is saying yes, sir. Perfect. So let's continue with the next topic, people. Assignment of life insurance policy. Assignment of life insurance policy. This was the section. This section was first used by whom, people? Can anyone tell me this section was first used by which person? Yes, people. Veni, Vijayalakshmi, Vaishnavi, Padmavati Srinivasan, Pooja Gupta. Where is Pooja Gupta, guys? Pooja Gupta, where are you? Ria Katuria. Can anyone tell me who was the first person to use this assignment of life insurance policy? Can anyone tell me? His name is people Dhirubhai Ambani. Dhirubhai Ambani. Yes, people. Dhirubhai Ambani, section 38. Now let's understand what is the meaning of assignment of life insurance policy. Transferring ownership rights of a policy from the policy holder. I am 100% sure you did not understand anything. Okay, let's say Ramesh has taken a life insurance policy. Ramesh has taken life insurance policy. Now, Ramesh is supposed to pay to Suresh how much? 1 crore rupees. Ramesh is holding life insurance policy. Ramesh is now supposed to pay to Suresh 1 crore amount. Now he does not have money. So what he will do is, he will now transfer or assign the life insurance policy to Suresh. He will assign this life insurance policy to Suresh. Now he will become the owner and he will get the money. If something happens to Ramesh, who will receive the money? Ramesh will not receive the money. Suresh will receive the money. The moment Ramesh dies, Suresh will receive the money. Has Suresh taken life insurance policy? No. Who has taken life insurance policy? Ramesh has taken life insurance policy. Now he has transferred the ownership rights to whom, people? Suresh. Now Suresh will receive money when Ramesh will die. Easy, people. Jyoti Kumari. Hi Jyoti Kumari, how are you? What's up? Okay. Now let's understand this explanation part. Assignment means transferring the ownership rights of a policy from the policy holder, Ramesh, to another person, Suresh. Once assigned, the assignee means Suresh will be the assignee and Ramesh will be the assigner. Assignee becomes the legal owner of the policy, has the right to claim benefits, can use the policy for loan. Tomorrow, Suresh can take a loan against Ramesh life insurance policy. Why? Because now Suresh is the owner of this life insurance policy owned by Ramesh. Easy people. Now are you able to understand this? Clear people? If you have got any doubt, just let me know. If you have got any doubt, just let me know. For all the people who are watching this video after the marathon, whatever doubt you have, immediately drop all your doubts in the YouTube comment section. Drop all your doubts in the YouTube comment section. Okay, guys? Okay. Now, types of assignment, absolute assignment or conditional assignment. Let's understand this using an example. A person assigns a policy to a bank for a loan. Once the loan is repaid, the bank reassigns the policy back. This was used by Dhirubhai Ambani people. Dhirubhai Ambani used this method. He used absolute assignment where Dhirubhai Ambani took loan from bank while giving life insurance policy as collateral. Very easy. What is the meaning of conditional assignment? What is the meaning of conditional assignment? A father assigns his policy to his son and puts a condition that he will receive benefits only when he will complete the education. He will receive the benefit only when he will complete his education. This is called as conditional policy, conditional assignment. Now let's understand the meaning now. Absolute assignment, full permanent transfer for all rights to the assignee. Conditional assignment, rights transferred temporarily or under certain conditions or under certain condition people. Now legal requirements, it must be in writing, signed by the assigner and witnessed obvious, must be notified to the insurance company that I have assigned this insurance policy to this XYZ person. You have to notify. Rights of the assignee, can surrender the policy, can borrow money against it, can receive all benefits. Termination, if assignee transfers it back, it's termination of assignment. If the policy matures or the insured dies, if Ramesh dies, Suresh will get the money, contract will be terminated. Very easy people. Next comes nomination in life insurance policy. Nomination in life insurance policy. This is what employees did with Reliance. What is nomination? When a policy holder employees name someone, Reliance, to receive the policy money after their death is called as nomination. We all know those people, very easy. Types of nomination, beneficial nomination, collective nomination. What is the meaning of beneficial nomination? A husband nominates his wife to claim to be as beneficial nominee. She gets the full claim amount. Very easy. Normal nominee, beneficial nomination. What is the meaning of collective nomination? A father nominates his wife 50%, his son 30%, daughter 20%. Where more than one nominee is appointed with fixed share is called as collective nomination. Everyone with me, give me a quick thumbs up, guys. Jyoti Kumari, what message did you delete? Jyoti Kumari. Jyoti Kumari's first message was deleted. Why, Jyoti Kumari? What was that in that message? Guys, someone deletes the message. I am more curious as to what was there in that message. Yes, Padmavati Srinivasan, Veni, Vasvi Lakshmi, Vijay Lakshmi, Vaishni Nagaranjan, everyone with me, give me a quick thumbs up, guys. Okay. Now, let's move on to the people. Legal requirements, again people, while buying, can be done while buying the policy or later, must be made in writing, can be changed anytime by the policyholder, receives the death claim, not the owner of the policy unless assigned. must distribute funds to legal heirs unless beneficial nominee cancellation can be revoked or changed. A new nomination automatically cancels the old one. Very easy, people. Now, what is the difference between nomination and assignment? Difference between nomination and assignment. Purpose is to transfer ownership right, but over here purpose is to appoint a beneficiary for death claim. If something happens to me, my family will receive the money. What is the effect? Assignee becomes the policy holder. Over here assignee becomes the owner, but over here nominee will not become owner. Nominee will only receive the claim. When will applicable? During policy holder's lifetime it will be applicable. Only after policy holder's death nomination is applicable. Okay. Now people, next topic is very, very easy again. Capital requirements for insurers. If it's life insurance, 100 crores, general insurance, 100 crores, health insurance, 100 crores, reinsurance, 200 crores. Very easy. Okay. People, capital increase. Insurers can increase the capital as per Companies Act 2013 and SEBI Act 1992. Net owned funds. An insurer must have net at least 5,000 crores in its net owned funds. Insurance must have at least 5,000 crores in its net owned funds. Net owned funds mean, people, what? Capital plus reserves. Capital plus reserves minus intangible assets. Intangible assets. Basically, it's net worth. Net worth of the insurance company should be minimum 5,000 crores with minimum paid up capital. Minimum paid up capital is different from net worth, net owned funds, people. Capital is different, net owned fund is different. Capital is the actual amount of money you have put in. Net owned fund is the actual net worth of the insurance company. Okay. Now, this is very easy, people. Just read it. Key takeaway, not important. Additional capital requirements. Okay. If it's equity based capital structure, company must be in the form of equity shares. Insurance company should be based on equity shares. No preference shares. Why? Because preference shares do not have any risk. Equity shareholders will have risk. Tomorrow, if fraud is detected, preference shareholders will not have any risk. Equity shareholders will have the risk. So, to keep somebody accountable, that is the reason why this rule is being. Hello. Am I audible, guys? Guys. Now, am I audible? Yes, people. Perfect. Now, people, I was saying that 3 more topics are remaining, then we are done. Just give me 15 minutes. That's it. Okay. Investment and loan regulations. Investment in approved instruments. Now let's understand this. Insurers must invest They are controlled funds only in approved investment. Example, LIC, a life insurance company like LIC cannot invest policyholders' funds in risky startups or speculative stocks. They cannot gamble using policyholders' money. They must invest in government bonds, blue chip stocks, or other safe approved instruments. Limitations. Investments are subject to specific limitations, conditions, and restrictions set by the regulatory authority. IRDA will tell them that where can you not invest, where should you ideally invest. They have to follow the prescribed rules mentioned by the IRDA. They cannot invest policyholders' money randomly in risky startups. No. This ensures insurance companies don't take unnecessary risk with policyholders' money and maintain financial stability. Investment in promoter companies. If HDFC Life Insurance has 1000 crores in controlled funds, it can invest only up to how much? 50 CR, that is 5% in its promoter company, not more than that. An insurer cannot invest more than 5% of its controlled fund or assets in companies owned by its promoters. Why is this law made? This regulation prevents insurance companies from unethically favoring their promoters over making sound investment decisions. They should not put the promoter situation in favorable to investors, policyholders. Such investment must comply with conditions. This ensures that funds are invested for the benefit of all the policy holders, not for the promoter companies alone. Not for the promoter company alone. Right, people? Very easy. People, now we are learning the law along with the logic. We are understanding why the law has been made, what exactly the law is saying, and also we are understanding the importance of the law. That's it, people. This is how you have to study the law. People always remember one thing, that whenever we are studying any law, we are studying the problem solving techniques. Meaning, what is the meaning of this? Whenever there is any problem in the nation or anywhere if there is a problem, law is the solution to the problem. We are not just studying law like this in a bare minimum. Right, people? We are studying law. How? We are always studying the solution to the problems that was happening earlier, and the law is the solution to that problem, to those gaps that were happening earlier. We are basically studying the problem solving techniques by the Insurance Regulatory Authority of India. Right, people? Okay. Next, prohibition of loan. To whom insurance company cannot give loans? Insurers are prohibited from giving loans to individuals or businesses except in specific cases. Okay. Insurers cannot give loans to whom? Directors, managers, actuaries, auditors, officers. Does anyone want to do actuaries after they complete CMA final? Just let me know in the comment section. Okay. Any company or firm where these individuals hold a managerial position, obviously they will not get a loan. Loans against, what are the exceptions? Loans against life insurance policy. Dhirubhai Ambani. Insurers can lend money to policy holders up to the surrender value of the policy. Loans to banks. If permitted by IRDAI, insurers can lend money to banking companies, no problem. A director of Bajaj Alliance cannot take a personal loan from the company, cannot take the personal loan from the insurance company. However, a policy holder with 5 lakh rupees life insurance policy can take a loan up to policy holders surrender value. We have already learned this, people. These restrictions prevent misuse of insurance funds and ensure that loans are given under strict conditions only. People, tell me one thing. In section 185, we have learned that company can give loans to directors, but over here we are learning that insurance company cannot give loans to directors, Now you tell me, Company Act is saying one thing and Insurance Act is saying one thing. You tell me which one would prevail and why. Which one would prevail and why? Can anyone tell me? Companies Act is saying that insurance company can give loans to directors, but Insurance Act is saying that you cannot give loan to directors. Which act will prevail and why? People tell me. Until then, I will continue with my next topic, okay? If I do not receive any response, I will believe that you guys don't know the answer, so I will tell you the answer, okay? But please, people, I would request you all to at least try giving answers, okay? Whatever comes to your mind, just tell me. Whatever is coming to your mind, just tell me. We are going to celebrate mistakes. Make as many mistakes as possible, people. I want you guys to make as many mistakes as possible. Okay? Perfect. All right. Liability, obligation, investigation powers under Insurance Act. People, I would want you to learn this, read, understand on your own, people, on your own. I hope everyone have got my notes. Give me a quick thumbs up for those who did not get my notes. Okay? This is very easy, people. I will not put time in explaining this. This is very, very easy. Basically, if something happens, who will be liable? Held liable. Directors will be held liable. This I will explain. Okay, this is important. This is interesting. Okay, guys. Perfect. Now, what are the obligations of insurers in third-party motor vehicle insurance? Let's understand this using an example, the meaning of third-party motor life insurance. Okay. Third-party motor life insurance is mandatory for all vehicle owners in India. For all vehicles owners in India. Why? Supposing tomorrow if I am driving a car and I hit somebody while I was driving. Now, even though it does not matter if that person has got life insurance policy or not, if that person has got insurance or not, it doesn't matter. Insurance company will end up paying that person. Why? Because I have already third party life insurance policy. Basic reason. So that everyone is protected. Everyone is protected under damages. Let's understand this, people. Third party motor life insurance ensures accident victims are compensated under IRDAI. IRDAI ensures that insurers do not avoid such policies due to lower profitability. Okay. General insurance company must sell. What is the meaning of general insurance, people? General insurance are those companies which sell all types of insurance except life insurance. All types of insurance except life insurance. They sell third party motor life insurance. Covers damages to others. Covers damages to not us, to others in case of accident. Certain insurers like health, reinsurers, agriculture insurers and export credit insurers are exempt from selling third party insurance. Yes, people. This law was made because third party life insurance is mandatory for all vehicle owners in India. Why? To ensure that accident victims receive compensation even if the driver doesn't have a personal insurance. If the driver does not have a personal insurance, still he will end up receiving money. Why? Because I have taken third party life insurance policy. I have taken third party life insurance policy. Everyone with me, give me a quick thumbs up, guys. Give me a quick thumbs up if you understood the concept of third party life insurance policy. Third party's motor insurance, sorry. Third party motor vehicle insurance. Everyone, give me a quick thumbs up, guys. Yes, people. Vijay Lakshmi, Veni, Jyoti Kumari, Padmavati, Srinivasan, Vijay Lakshmi, Vasvi Lakshmi, Vaishnavi Nagaranjan. Guys, where are you? Guys, where are you? Okay. So people, the next topic is power of investigation, inspection, inquiry. I would want you to read, understand and learn. Very easy people. Let's not waste time in explaining this, which can be done by you very easily, okay? But please ensure people after you complete the marathon video, you learn from my notes, okay? You learn from my notes, very important. Next is prohibition of commission payments and regulations on insurance agent. People, I think this is the last topic. Okay, well, this also I would want you to read, understand and learn. People, I have included every single thing in this table itself, okay? In 2 pages table, I have included every single thing along with examples, okay? I have given you examples, I have given you explanation. So it's going to be a very easy cakewalk for you guys. In case you have got any doubt with respect to any topic, people, just immediately drop all your doubts in YouTube comment section, okay? YouTube comment, drop your doubts and I will ensure that all your doubts are resolved within 12 hours. Maximum 12 hours time you give me, all your doubts will be resolved, okay? This thing I would want to read, understand and learn on your own, okay? Right people, right. So let's come to the last topic, that is prohibition of commission payments and regulation on insurance agent, okay? Perfect. Let's start. Basically, people, are you able to view my screen clearly? Give me a quick thumbs up if you are able to, if my screen is visible to you clearly. Yes, people. Everyone. Is my screen visible very clearly to you guys? Joshua Koshi. Hi, Joshua Koshi. Where have you been? Joshua Koshi, I think you have come to my marathon live. Right, Joshua Koshi? Where are you from, buddy? Okay, guys, until then, I hope my screen is visible. I'm continuing with my last topic, that is prohibition of commission payments and regulations on insurance agents. This is basically rules for the insurance agents who are selling insurance policy. Right, people? Let's understand this. Prohibition of commission payments for procuring business. Basically, let's understand who can receive commission. Only licensed insurance agents or intermediaries, licensed insurance agents and intermediaries can receive commission or remuneration for obtaining or selling insurance business. Basically, they are soliciting, means what people? Soliciting means getting clients is called as soliciting. A licensed insurance agent can receive commission for selling policies from Max Life Insurance or ICICI Prudential Life. Very easy. Only people who have got license plus they have got intermediaries, only they can sell, only they can receive commission. Who cannot receive commission? Any person who is not a licensed insurance agent or intermediary cannot receive payment or rewards. Easy people. A car dealer cannot receive commission for referring customers to SBI life insurance unless they are registered as insurance intermediary. If they are not registered and if they are soliciting clients to SBI, they cannot receive any commission. They can only receive commission if they are registered with insurance as intermediary. Yes, people. Regulation. Agents and intermediaries must comply with IRDAI regulation, obviously, people. Okay. Example, A real estate agent cannot receive commission for referring clients to an insurance company unless they are registered insurance intermediary. We all know this, people, very easy. Okay, next, appointment and restrictions on insurance agent. Appointment and restrictions on insurance agents. Okay, insurers can appoint individuals as agents if they meet qualification criteria. If they do not have qualification, how will they become agent and are not disqualified as per IRDA regulation? If they are not disqualified by IRDA regulation, number one, plus if they are qualified as per IRDA regulation, only then they can become an insurance agent. Otherwise, they cannot become an insurance agent. Bajaj Alliance can appoint an individual as an agent if they complete the IRDAI approved training and pass licensing exam like we do, people. CMA, ICSI. In the same way, they also have to pass the exams. Restrictions on working with multiple insurance. A person can work as an agent for Max Life Insurance and New India Assurance, but they cannot work for both ICICI Prudential and HDFC Life Insurance. People, can you tell me the difference? What is the meaning of this? You cannot work as a life insurance agent for more than one company. You cannot work as an agent of life insurance for more than one company. But you can work as an agent for two companies provided you are in different sector. You are in different category. You are in different category. If you are working on behalf of, if you are working as an agent of two different insurance company, allowed. If you are into the same category, not allowed. You have to be in different category, allowed. If you are into life insurance and if you are into marine insurance, allowed, people. An agent cannot work for more than one insurer in the same category. This avoids conflict of interest, right, people? Restricting agents from working with multiple insurers in the same category will help maintain transparency and avoid biased promotion of competing products. Otherwise, what will do, people? If I have bias towards one, if let's say SBI Life Insurance, and let's say HDFC Life Insurance. I am the agent of both the life insurance. So obviously, people, the one from whom I'm getting lots of benefit, I will always favor them over other. This thing should not happen. That is the reason why this law is made, that agents cannot be the agents of two companies, two insurance companies of same category. They can be agents of different category, no problem. Next, ban on multi-level marketing. People, we all have come across this scheme where we refer to some other person. If we refer to some other person and that person will again refer to some other person, we will receive money. Multi-level marketing, you meet three people, X, Y, Z. These three people will receive, again meet A, B, C. He will meet E, F, G. And they will receive some benefits because they have referred something. This is called as multi-level marketing. Basically, this is banned. No person can offer or induce others to buy or renew insurance through multi-level marketing, where individuals earn commission by enrolling others in a chain. This is called as a chain, people. Amway style schemes where agents recruit people and get paid for sales made by recruits are illegal in the insurance sector. Agents are not selling. Agents are recruiting people who will sell them, and the commission will be earned by both the agent as well as the recruit. That should not be the case, people. Multi-level marketing is banned. Such pyramid-based marketing are illegal in the insurance sector. Okay, MLM schemes and pyramid structures are banned in the insurance industry to prevent unethical and exploitative business practices. Last topic. Insurance agents cannot be directors of insurance companies. Can anyone tell me the reason why insurance agents cannot be directors in insurance company? Joshua Koshi has deleted a message. You are from Kerala. Amazing, Joshua Koshi. Amazing, amazing, amazing. Yes, I remember now. So basically, people, if I am the agent selling life insurance policy and I am also director of insurance company, then I will always make policy, I will always make decisions that is going to be in favor of life insurance policy. Why? Because I am the agent of life insurance policy. So over here again, people, conflict of interest is coming. For that purpose, an agent cannot be a director. An agent cannot be a director. An insurance agent or intermediary cannot serve as a director of insurance without special approval from IRDAI. This prevents conflict of interest when an agent may favor a specific insurer for personal gain. If an insurance agent sells ICICI Prudential Life policies, they cannot be on the board of ICICI Prudential Life unless IRDAI approves. Prohibiting agents from being director in the same company ensures impartiality and transparency in insurance operation. So people, we are done with the insurance laws. We are done with the insurance laws. People, below this I have given you MCQs along with the answers. 50 MCQs I have given you, people. Solve it, okay? Just solve all the 50 MCQs. Then people, we are done with the insurance laws. That's it. Now we can say that we are done with 100% of our syllabus. We are done with our 100% of our syllabus. Number one, we are done with 7 days live marathon where we have covered every single important topic of every single chapter is done. I have also taught you how to remember sections like a magician. Remember sections like a magician. I have made 2 videos on this, people. You can watch those videos. 2 videos. I have also taught you how to write answers in the exams. 3 type of answers. The answers which you do know, answers you do not know. And number 3 is, people, and third category was, what was that? Third category, case study based. Yes. Theory based, case study based, and those answers which you do not know. Now we are done with insurance laws also. Yes, people. So, people, every single thing has been done with. Every single thing is done with. 7 days live marathon is done. Number 2, I have taught you how to remember sections like a magician is also done. Number 3, I have taught you how to write answers in the exam also. Theory questions, case study based questions, as well as questions to those answers to those questions which you do not know. Number 4 is insurance law is also done. Tomorrow, I will come live for banking laws. Day after tomorrow, we will solve MCQs. Then people, you cannot find, people, there is no reason for you to not to score an exemption in corporate economic laws. That's it. Everything is done, people. Everything is done. So people, we are done with today's session. So I will see you in the tomorrow's session soon, people. Vijay Lakshmi, Veni, Joshua Koshi, Jyoti Kumari, everyone, Padmavati, Pooja Gupta. Where is Pooja Gupta? Pooja Gupta, Vaishnavi Nagaranjan, Vasvi Lakshmi, everyone. So people, let's end the session here. Thank you so much for watching, people. Thank you so much for watching. It really means a lot that so many of you have stayed active. Even despite exams are very near to you, it really means a lot, people. It really means a lot. People, thank you so much for watching. Take care of yourself. Eat well, sleep well, study well. Thank you so much for watching. I will see you tomorrow live soon. Joshua Koshi, Veni, welcome guys. Welcome so much. Welcome. Yes, people, I will end the session here. Thank you so much for watching. Take care of yourself. Okay. Right.